This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional.
All right, let's dive into something that honestly has some pretty serious financial implications for all of us. We're talking about the very real and growing risk that the United States could see its credit rating get downgraded again.
So here's how we're going to tackle this. First, we'll look back at a little bit of history, how we even got to this point. Then we'll dig into the why, the real reasons for the risk. After that, we'll talk about what it could mean for you, the tough choices on the table, and finally, what the future might hold. Okay, let's jump right into the history. You see, for the longest time, the US had a perfect credit score, a real gold standard. But, well, that's not the case anymore. And to really get why that's a big deal, we need to be clear on what that perfect score even means in the first place. Think of a AAA credit rating as the absolute best you can get. It's like the financial world's seal of approval. It basically tells everyone this country is rock solid and can absolutely pay back what it owes. It's a huge sign of trust. And, well, that's a status the US doesn't quite have across the board anymore. So take a look at this timeline. You start to see a pattern emerge, right? The first little crack showed up way back in 2011. That's when S&P said, hey, we're worried about the debt. Then fast forward to 2023, and Fitch does the same thing. But this time, they're also pointing a finger at political division. And just a few months later, Moody's, the last one holding out with a stable view, flips its outlook to negative. And what are they all saying? It's the same story. Rising debt and political gridlock. It's a recurring theme. Okay, so that really sets the stage for our next part. What are the core reasons for all this? Let's get into the nitty-gritty, the numbers, and the behaviors that have these rating agencies so worried. And really, it all kicks off with this massive number, $38.4 trillion. That's the national debt right now. I mean, just let that sink in for a second. It's a mind-boggling figure, and it's the bedrock of this whole issue. But, the giant number itself is only half the story. The cost to just pay the interest on that debt, that's where things start to get really scary.
And this chart, wow, it just lays it all out, doesn't it? Just look at how fast the interest payments are exploding. Back in 2020, it was $345 billion. Okay, a lot of money. But by 2023, it almost doubled. And the projection for 2025, we're talking nearly $1 trillion a year. And that's not paying down the debt, that's just the interest. It's become one of the biggest line items in the entire federal budget.
So here's the thing you got to remember. These rating agencies, they don't just look at a big pile of debt and call it a day. No, they look at behavior. And right now, the US is waving about 5 huge red flags. Deficits just keep going up. We just saw those interest costs going through the roof. The political infighting seems to get worse and worse. There's no real long-term plan for huge programs like Social Security and Medicare. And maybe the biggest red flag of all, the debt is growing faster than the entire economy. That's a recipe for trouble. I know. This can all sound like some abstract government problem, right? Numbers with lots of zeros. But it's not. So the real question is, why should you care? How does this actually affect you and your wallet? And that's a perfect lead into our next section. What are the potential economic consequences? Because a country's credit rating isn't just some grade on a report card. It has very real, tangible effects on the cost of money for, well, pretty much everyone. Okay, so if the US gets another downgrade, you can think of it like a domino effect. See, US government debt is kind of the benchmark for the whole global financial system. So if it costs the government more to borrow money, that cost gets passed down, it ripples out. And what does that mean for you? Well, it could mean higher interest rates on your mortgage. It could mean more expensive car loans or business loans. You could see a lot more ups and downs in the stock market. And on a bigger scale, it weakens trust in the US and could even lead to the government printing more money, which, as we know, can lead to higher inflation.
Yikes. So when you hear all that, the next question is pretty obvious, and it's a big one. Can this be fixed? Is there a way out of this mess?
Which brings us to the possible solutions. But here's the tough part. When you're talking about a problem this big, there are really only 3 ways to tackle it. And spoiler alert, none of them are easy, and they're definitely not popular. All right, path number 1, you could cut government spending. The problem? That's super unpopular politically and almost guarantees a backlash from voters. Path number 2, raise taxes. Again, deeply unpopular, and people will push back hard. So what's path number 3? Just print more money. Politically, this is often the path of least resistance, but it's a dangerous game because it can seriously devalue the dollar and fire up inflation. So you've got 3 really tough choices, and it seems like there's very little political appetite to pick any of them. So where does that leave us? Let's wrap things up by looking at what might be next, and it's a pretty uncertain picture.
And this quote really says it all. The feeling isn't just that another downgrade could happen, it's that it's probably going to happen. When you combine that skyrocketing debt with total political paralysis, well, it's hard to see which other direction things could go.
So, what's the bottom line here? The big takeaway is that the path we're on right now just isn't sustainable. The rating agencies are just pointing out what we can all see. The debt is exploding, interest costs are soaring, and the political system seems broken. Without some kind of major course correction, it feels like the question isn't if there will be consequences, but what those consequences will look like. Thanks for watching this video overview on 15 Minute Investor.